All right, everybody. Welcome to the October Trading Mastermind. I have a very special guest today. Famous author, legend amongst option traders or option sellers. I'm super excited to introduce you to him in just a second. But real quick, let's just go through the housekeeping shenanigans. This is our famous disclaimer. If you need to read it, just pause the video and read it to your heart's content. Read it a couple times, make sure you get it. Basically, what it's saying is that this is not financial advice of any kind. This is just for entertainment, educational purposes only. Don't do anything we do. And before you make any trades at all or invest in anything, go see your own personal licensed financial advisor. So that's the disclaimer. Now let's get to the good stuff. Today's mastermind session. Today, I have the pleasure of introducing my friend, Lee Lowell, who back in the 2000s, when I first started getting into options, I ran across his book. It was one of the first books that really resonated with me. I think it's one of the books that a lot of folks have told me this, that this was the first book that was kind of written for the retail crowd. They could understand it. It really clicked, made options click, moved the needle, and it did for me. So I'm going to hand the keys here over to Lee. Lee is sort of known as, I consider him like the go-to guy for option selling strategies, and particularly put selling strategies. But he has a lot of other really cool strategies as well. And he's going to share some of his good stuff with us today. So Lee, I'm going to stop sharing, and then I guess you'll share.
Yeah, I'll share in a second or so. Good evening, everyone. I want to thank you for coming out. I know it's always difficult at nighttime to join these things, but I appreciate that. I'm always here to give out some information on options trading. I've been doing this for over 30 years, and I'm still at it, still love it. It's great when you're in a business that you love, and you love working with people who want to learn how to trade options. A lot of my business these days centers around teaching people how to trade stock options, and I'm really passionate about it. So I definitely want to give some good content here tonight and answer lots of questions if anyone has any questions. For me, options trading started long ago, over 30 years, trading commodity options and commodity futures. And the options side of it really kind of got to me. It was a way to figure out how to trade puts and calls and spreads and make money regardless of what was happening around me. I think one of the biggest things that I take away from the options market is that having to pick a direction is not the only way to make money. Most people who invest today, whether that's stocks or outright buying calls and puts, you really have to rely on being able to pick a stock's direction and get that direction right in order to make money. Most of us are there to buy stocks, and if the stock goes up, great, we win. If the stock goes down, we lose. And it's really just a very black and white way of trading. You either win or you lose, and there's not much more to it than that. And that could be very disheartening if you invest a lot and you get the direction wrong and you lose money. It's not a lot of fun. So what the options market can do for you is to allow you to not have to rely on direction alone in order to make a profit from options trading. And the way to typically do that is by using option selling strategies, whether that's straight up put selling, selling credit spreads, selling iron condors. I know Dan does a lot of those trades, and he's told me that a lot of you are pretty familiar with most of those types of strategies. So I love selling options. That's probably 99% of what I do. I sell puts. I sell a lot of naked puts. I sell put spreads. The only real type of option buying strategies that I do is buying deep in the money calls, which is, one of the strategies in my book. If you see the book behind me here, that's the book Dan was talking about. In my opinion, there's really only 4 strategies that the average investor really needs to know about. And if you're bullish and you want to take a long position, you can substitute buying a deep in the money call instead of buying the stock. And then you can sell another call against it, which would act like a covered call in a way. We call it the poor man's covered call. I think some of you may know about that strategy. And so Dan and I were talking, and I wanted to be able to give you some ideas of some of the trades that I do. So I ran some things by Dan, and he thought, that would be kind of cool if we talked about some of that. Um, there's a strategy of buying deep in the money call spreads, which to me, it's all about probability in the market, in the stock market, options market. It's all about probability. Will the stock go from point A to point B in X amount of days? And these probability calculators can pretty much tell you, what odds do you have of a stock getting from point A to point B? And um, when you buy a deep in the money call spread, let's say the stock is here, you're buying call spreads on strike prices that are down here that they already have the probability behind them. If the stock keeps going up in the direction that you think it will, that deep in the money spread will just widen out to the width of the spread itself. So you already have like a kind of like a locked in profit in a way that as long as the stock doesn't tail back down on you partially, you're going to make money. So I like to play with the probabilities quite a bit. And, buying options to me is really such a hard way to consistently make money over time. A lot of people come to me, they don't have a lot of experience in the market and they've seen other things on YouTube or TikTok or Instagram, whatever, and they see these people, guys and gals, I can't say whether they're pretending or not, but they're showing off ways to make money every single day, like lots of money. And after you try these things for a while, it really doesn't work. There's a lot of hype there. Trying to day trade, trying to make money directionally in the market every single day is tough, and it can grind you down and it wears you down. I have not met many people that can do that for a living, where they're outright buying calls and puts and making money day after day to I'd say to make that their only sort of job. It's a hard slog, but some people can do it. I know Dan here, he's making money with his trades, so that's good. But to me, really, it's all about the probabilities, and buying these deep in the money call spreads is really a great way to do that. So let me share my screen here for a second, and we can kind of look at some things. Um, Let me pull this up here. So I've got an option chain here, and I've got Tesla pulled up. I just want to make sure everyone could see this. I don't know if anyone is. Dan,
Yeah, I can see it.
Okay.
Can someone else just kind of chime
Yeah,
in?
we
'Cause
can
I'm
see
a-
it.
Okay.
Okay, thanks.
Perfect. So why don't we go to something not as volatile as Tesla? Let's look at, let's say, I don't know, we can even use NVIDIA. So the way I'm thinking about things is really on the probability side. Now let's go out another month or so. Let's go to November. Most people that I talk to, they have their days to expiration, 60 days or less. Typically, they like to trade short term. So we'll look at NVIDIA here for the November expiration, 52 days left. So most people would think, if you're bullish on NVIDIA, I'm going to go out and buy an at the money call or an out of the money call. And NVIDIA is trading around, let me move my thing here, about $185 and change. So most people would either buy 185 call for, $1,340. Here's the prices over here. Or they'll go out to maybe, I don't know, a 230 call and pay $150, $150 for a 230 strike. In that case, the stock has to move above 230 bucks if you're going to hold that thing to expiration. And, that's almost, that's a $45 move for NVIDIA in the next 52 days. It could happen, but you're sort of playing the hope and the hope kind of factor. You're hoping that the stock's going to go up far enough for you to make money. I'm sure everybody knows how to figure out the break even. You take the strike price and you add the cost of the call here. So it's really $231.50 that NVIDIA would have to go up in the next 52 days. And you can look at the delta. The delta is roughly 11% here. So you have 11% chance as the option buyer to win. To me, that's not enough probability. I like something that has more a higher chance of winning. So, in the case of buying deep in the money call spreads, you go down in the strikes here, and each strike is about $5 apart. So the width of that spread can be no more than $500. So if you look at something like, let's just say the 155, 160 call spread, it's probably worth about, you can probably buy this thing for $3.50 maybe, I'd say, somewhere around there. So if you pay $3.50 for that call spread, the max it can go to is $5. And as long as NVIDIA stays above $160, you're going to make the max on that trade. You buy for $3.50 and then eventually it'll be worth $5. And if you know that NVIDIA is sort of in an uptrend and most stocks that are in a trend are going to remain in that trend for the foreseeable future until something really nasty comes along. So as long as you're looking at the stock charts and you're knowing that a stock is in an uptrend, you've got the momentum behind you. So, but instead of trying to pick a place where the stock needs to get to, why don't you pick a place where the stock is already blasted past and just play in that regard, where it's already above 155, 160 bucks. It's at $185 already. As long as NVIDIA doesn't crap out to 160, this call spread will widen out to the maximum $5 and you've paid $3.50 for it or whatever. So you're playing with high probabilities here. Okay. In this case, you've got somewhere around an 85% probability that NVIDIA is going to remain above $160 a share. So those are the kinds of trades I like to do, these higher probability trades. Now, on the flip side, for every call option spread that you buy, you can conversely sell the put option spread, and it would have the same risk reward feature. Okay. Now, as an option seller, for me, even though I just showed you how to buy a deep in the money call spread, I would pretty much turn that around and sell the 155, 160 put spread for, it looks like, maybe 85 cents or so, 80 cents. So in this case, you'd have to buy this thing for a little over $4. You can sell the 155, 160 put spread for, let's say, 85 cents. And as long as NVIDIA stays above 160, this thing's going to decay down to zero and you're going to make your money. So for me, it's all about probability. I like to play these higher odds. I'm not looking to, I like to make unlimited amount of money, which is what happens when you buy outright individual naked calls or naked puts. But the chances of you making unlimited amount of money is not really going to happen, unless a stock gets bought out or, some other massive news comes out. But you can't rely on that kind of way to trade. You can't always hope that, a stock's going to get bought out or something like that. So I would rather just play the limited risk, high probability types of trades. So in this case, we do a lot of selling these out of the money put spreads. Conversely, you can buy the in the money call spread. It's the same risk reward feature. Okay. Either way, it's going to be worth $5. The spread right here is going to be worth $5, or it's going to be worth $0. Now, if you buy the call spread at 4, you hope it's going to widen out to 5. If you sell the put spread for $1, you hope it's going to drop down to 0. And the risk reward is the same. You spend 400 here to make 100, or you make 100 here to risk 400. It's the same on both sides. It's just whether do you want to buy the in the money call spread, or do you want to sell the out of the money put spread? Doesn't matter. It's the same thing. As long as you know that the stock is in an uptrend. Let me just bring up the chart here. So this is pretty much how let me share the screen here. So I'll get a chart of NVIDIA here. So here's your longer term chart of NVIDIA. This is about a 2-year look back period. And we all know NVIDIA is in an uptrend, and it's probably going to keep going in an uptrend. So if you want to play NVIDIA, you're going to play it on the bullish side because it's going up. It's got good support. There's so many people behind it. So many people are bullish. Why would you even attempt or even entertain the idea of taking a bearish trade on NVIDIA when it's got all this uptrend behind it. I know there's people who like to take contrarian trades. NVIDIA all-time highs here. I think it's all-time highs. A lot of people say it can't go any higher. I mean, it has to have a pullback. It cannot go any higher. Just because a stock is making new highs doesn't mean it can't keep making more new highs. I learned that long ago. I used to try to fight the market. I used to think, gosh, NVIDIA's gone up so much, it has to pull back. And every time it would just keep going up on me and I would lose money and it would frustrate me. So I learned long ago, don't fight the trend. The trend is your friend. So if you see a stock in an uptrend, go with it. Even if it's making all-time highs, you can still go with it. Now, in the case of NVIDIA, so here it's at 186 or so, and we're looking down at these right in here, this 155, 160 zone, where it would take, a good amount of selling to get it down there and keep it down there. Like I said, as long as the market is going up and people are still buying stocks and there's no really bad outside noise, then most stocks are going to just keep going up in the long run. So it's better to play with the trend on your side. No reason to fight it, but take the higher probability trades. That's what we like to do, or what I like to do, and it will pay off for you. If you're struggling with your option trades and your results just aren't where that you want them to be, it's probably just a matter of looking at things a little differently. Maybe you're trying to fight the trend, or you're just trying to buy out of the money strikes, and the stock's just not getting there in the amount of time that you need it to. I've always defaulted to my bread and butter is pretty much selling put options, and I like to sell deep out of the money put options. Strikes that are all the way down here. Now, if we look at, let me go back into the option chain here. And we'll look at Tesla for a minute because I want to talk about selling deep in the money puts as well. Dan, you guys talk about selling deep in the money puts? I don't remember if you and I discussed that.
As in as naked puts, as a way to maybe get the stock assigned to you?
Yes. And just if you're extremely bullish, selling like 90 delta put options.
Yeah, not really. But I'd love to hear your take on it.
So let's go back to Tesla, because Tesla has got incredibly juicy option premiums. I love selling puts on Tesla because there's so many bulls out there. Tesla is so supported by so many people that it's really hard to see Tesla crashing in any way, shape, or form. Yes, it could happen. I mean, anything could happen, but the odds are favoring support and bullishness in Tesla. So, if you're going out to December, here's Tesla, $442. And this option chain I'm using is through Interactive Brokers. It's their paper trading system platform. So this is all fake money. All the data is real. It's just a fake money kind of account. So when you see things like, it usually says up here, it says simulated trading. Okay, so this is not a real account. But if you look at Tesla, it's trading at $442. I mean, you can go $200 out of the money to this, the 220 puts, sell these things right here for, $150, $150. And if you're using a margin account, your broker's not going to hold that much money aside as collateral. It's a good way to create this income flow for yourself. And even if you're bullish on Tesla and you're interested in potentially buying the stock for $220, you can sell these things. I do this all the time. And knowing that Tesla has got so much support, I know the chances of Tesla falling down to $220 is really, really small. But what I wanted to talk about was selling, a deep in the money put. And what I consider a deep in the money strike is something that has the 90 delta, about a 90 delta. So if your option chain has the delta column like this one does, we can go all the way up to let me find the 90 delta put here. And this is for December. We're looking at the 680 put. So I don't know if anybody's ever thought about selling a deep in the money put option. Tesla's at $442. We're looking at selling a $680 put, meaning if you were assigned, you'd have to buy Tesla for $680 a share, while it's currently trading at 442. But you're going to get compensated very well for it. You're going to get at least, this thing is probably worth $240 per contract. Okay, that's actually $24,000 that you would get for selling a 680 put. So if you look at it this way, I'm just going to pull up my calculator here for a second. You got the 680 strike minus 240, which is the premium that you would get. So your cost basis is really $440. Okay, you subtract 240 from 680, and it gives you a cost basis of $440. So if you were assigned, your real cost basis would be $440, which is a couple of dollars cheaper than where Tesla is now. So if you're thinking, you know what, I'm good with Tesla here, I would be okay buying Tesla at current levels around 440. I'm going to sell a 680 deep in the money put option. I'm going to collect $24,000 for selling that put option. $24,000 is going to get deposited right into my brokerage account. And as long as I'm not assigned early, I can collect interest on that money, that $24,000. And but it's an extremely bullish strategy. Okay. As long as Tesla goes up, as you hope it does, then this premium will start to decay and go down and go down and go down. Now, I don't think Tesla's going to go up $200 more in the next 80 days. But as long as it goes up something, this put option is going to go down. And that's how you make money when you sell put options, right? You sell put option at a high price, and then it declines in value, and then you can just buy it back and lock in your gain. Now, since this is a very bullish strategy, what you can kind of do to offset that, or hedge that, I should say, a little bit, you don't want to sell a naked call against it, because, if Tesla, whatever, they cure all the ills in the world, Tesla's going to go up to infinity. So you don't want to sell naked calls as a hedge against this thing. But what you can do is sell call option spreads. So if you want a little downside protection, these are things that I've done before. I've sold a deep in the money put, and then something like you sell a call spread, so you don't have unlimited risk, but you sell a lot more contracts than you do with the put option that you sold. So let's try to get about $1 per contract. So you're looking at a 530, 535 call spread. That's worth about $1. Okay. So you sell that thing for $1. You have $400 at risk. And if you sell 10 of these things, that's $1,000 in your pocket, another $1,000 that can protect you on the downside a little bit. Let me shut that thing down there. So, and if Tesla ends up going above $535, you'll lose the max on this. But the money that you'll gain from this put option that you sold, this deep in the money put option, is going to more than make up what you'll lose on that call spread. So selling the call spread is just kind of there to hedge you a little bit, give you a little downside protection in case Tesla has a pullback before it starts to run up again. So those are one of the things I like to do on a stock that I may be really bullish on. I'll sell a deep in the money put option a few months out, so the chance of early assignment isn't really that strong. And the way that you know whether early assignment is going to happen is that you can look over to the corresponding call option here. So we've sold the 680 put, and you look over at the corresponding call option. As long as that's got at least a few dollars of value, you're not going to get assigned on this thing too early. Okay. There'll always be, a very green or new option trader that says, I'm going to exercise my 680 puts and I want to sell these things at 680, but they're going to leave money on the table because these things, the call options still have value. That's the kind of the put call parity thing there. So I like to do that. I like to sell deep in the money put and hedge it with some call spreads. Like I showed you, because if Tesla really does go up, you've got that put that you sold to make up for it. So in this case, if we sold the 530, 535 call spread right here, if Tesla moves up from 440 to, let's say, 525, That's a good $80. This call spread will expire worthless. You'll take in $1,000 there and you'll still make money on that put that you've sold. So there's lots of different things. Dan and I were talking earlier. One of the best things about trading options is so many different combinations you can do, so many different ways to play it, so many spreads you can do, these calendar spreads, diagonal spreads, condors, all these great things. If you have that kind of brain where you like to tinker with things and you like to try to figure things out, that's why I love the options market so much. I feel like you feel like you're beating the system in a way when you can come up with these configurations and make money on these things. And for me, I also, a lot of people ask me what I do personally. So these are some of the trades that I do. You can sell these out of the money put spreads, high probability. You can sell these deep in the money puts individually, hedge them with selling some call spreads. I like to sell puts on the SPX. We can look at some SPX options here. I usually go either same day or one day out. These SPX options expire every single day. Now, what I do like to do is I go when the market opens in the morning, I'll go to the next day's expiration and I'll go $50 to $100 strikes out of the money, because basically knowing that on a typical basis, the SPX is really not moving that much. Or you can use the SPY options as well, either one. But, you can go 50, 60, 70 strikes out of the money and collect 10 or 20 cents per contract. That's 10 or 20 actual dollars. If you have the account size to handle selling the full SPX options, those are pretty high probability trades too. And those are cash settled. So you're never at risk of being assigned the whole index. If the SPX moves in the money on your option, your account will get debited the difference of the loss. So I'm not opposed to selling 10 cent, 15 cent options. That's 10 or 15 bucks on one day or the same day. I don't have a problem with that. I like to sell these cheap, deep out of the money puts because they're there and because they're super high probability. A lot of people that I've talked to in the past to say, why do you waste your time on selling such deep out of the money puts? You're only making $5 or $10. And I say, yeah, so what's wrong with that? It's super high probability. My margin's only tied up for a day. It's not a big deal. It's not like you're tying up tens of thousands of dollars for months and months just to make $5. I mean, I understand that. I don't do that. But these are the ways that I play in the market. Dan, any feedback, any questions? I can answer some questions along the way. I know I've been talking kind of quickly. I'm not sure if I've gone over the head of some people. I don't know if everyone understands what I'm talking about. I want to make sure that we're all sort of on the same page here.
Yeah. So some questions are accumulated in the chat, but I think that
Okay.
we'll just hit those at the end maybe. But a couple of things I had a question on real quick. So on the ones you were just talking about, the SPX options for like 5 cents, 10 cents, how and when do you hedge that thing if things look like there's a big move heading towards them?
If it's happening intraday, like the same day, and I've already sold these things, and then all of a sudden some really nasty news comes out, I have to decide where's my stop out point. I mean, these things are so deep out of the money that we really would have to have some kind of catastrophic news to really scare me out of the trade. If I have to, I'll just buy them back, or I'll try to buy, one or two higher strike put options, to kind of hedge these lower ones that I've sold. Like if I've sold like 5 of these things down here, I'll try to buy 1 or 2 of these things. So if the market keeps going down, at least I can make some money off these more higher strike puts. But if something really nasty happens, then I'm going to eat it and take my licks and buy the stuff back. And that's just part of trading. So there's that part of it where, nothing is absolute. Nothing's guaranteed. We can go to war tomorrow and the market could drop 5,000 points. I mean, you never know. And, I never like to take unlimited risks like that, especially on the upside. I'll never sell naked calls. I will never, ever sell naked calls, but I will sell a lot of puts because I know that things like this don't last forever. And, if I can buy Tesla or whatever, $200-300 cheaper than where it is now, these stocks are going to turn around. I mean, when we have outside news like this, whether it's interest rate cuts or interest rate rises by the US Fed, or President Trump starts talking about certain things and it gets the market all haywire, these companies are not going out of business. Okay. Apple will keep producing millions and millions of iPhones every year, and millions of people are going to keep buying iPhones, and Apple's just going to keep going up in value. So you have to look at these big down moves as opportunities. There's no other way around it. COVID was a once in a lifetime thing. I even got nervous during COVID. I took major steps back in my own trading, but there is a point where the market will come to its senses. And when you see that move start to turn up again, that's when you have to start going in a little harder than you normally would. We all saw what happened. Let me just share the screen here one more time. Let's go to the SPY real quick. I mean, you could look at any index. I mean, April, the bottom of April here, early April. I mean, look what the market's done since then. If you had some patience and some, balls, stepping in here was not a bad thing. I remember I bought some shares of SPY right around 480. RSI, way oversold. The VIX was spiking. One of the best indicators of a market hitting the bottom is the VIX spiking. I don't know if you guys talk about the VIX, Dan, but you're not going to get many spikes like this. And when the VIX spikes like that, you better be ready to back up the truck and buy the market, because the market moves inversely to the VIX. Here's that bottom. This is right here's the market bottom. That's when the VIX was spiking all the way up here. So yeah, over time, I've been doing this for over 30 years. These things tend to repeat over and over again. We're human beings. We're all trading in the market, and we all have fear and greed. And fear and greed always presents itself the same way at extremes. And the same thing happens all the time. People say, well, it's different this time. I'm selling all my stocks. This time it's different. And that's exactly when the market bottoms. I mean, you can use these indicators to really help you decide when it's time to get in. Now, the top is harder to predict. Okay. Usually what you'll get is the market will go slowly. It'll grind higher, grind higher, grind higher, grind higher, and then it'll have that quick, nasty move down. It's harder to pick the tops. But when the market is making bottoms, it's more of I'd say it's not a guarantee, of course, but it's more of a guarantee picking the bottoms than it is trying to pick the tops, because you got the VIX spiking, you got the RSI going into oversold territory. It's easier to get in on the long side after really nasty sell-offs like that when the VIX is spiking. So you got to use these things that are at your disposal to help you with your somewhat directional trading. Even when the market was bottoming here, I wasn't buying so much outright calls. I was still selling puts and selling put spreads, which still worked. As the market went up, I wouldn't make unlimited amounts of money because I'm not buying options. I'm selling options, which have a finite profit, but it still worked. So I'm still very conservative. When the SPY was here at 480, I was selling put spreads down here and selling puts down here. And when the VIX comes crashing back down, the volatility of those options come crashing too, so they decay that much quicker. So it's great to use the charts and the VIX and your indicators to give you an idea of what's happening. So that's pretty much the way I do it. Charts are the most important thing to me. Getting a handle on technical analysis is, in my opinion, the most important thing with any kind of trading. You need to learn how to read the charts. You need to learn how to find support. You need to learn how to use the moving averages here. I know for some of you that follow me on YouTube, I only use 3 moving averages, 20-day, 50-day, and 200-day, and the RSI down here. Those are the only indicators I use, and they have served me well over time. On some of my charts, I'll have the Bollinger Bands, which are good as well. But it's mostly, I'm looking for extremes. I'm looking for extremes like this. Here's an RSI way oversold. The price action's almost going vertical to the downside here. These things don't last that long. That's just how the market is. The market was meant to continually go up over time. You're never going to show me a stock that increases its earnings and revenue every month, every quarter, and the stock goes down. It just won't happen. So if you're following good stocks and the stock and the companies are pumping out accelerating earnings each quarter, the stock's going to follow eventually. So you just kind of have to know these things, and then you make your option trades accordingly. You have a stock like, I don't know, what's the stock that's been going down so much offhand? I don't even know.
Beyond Meat.
What's the symbol? Beyond? This one? Beyond? Yeah. I mean, this stock's been going down. I mean, it was $18 high, now under $2. It's in a downtrend. I mean, for me, there would be no reason why I would really try to get long here. Considering that, why would I want to get long on a stock that's going down? Because if you're trying to pick bottoms, let me just pretend here, like, Beyond is at $3.50. You're thinking, oh my God, this is the bottom. I'm going to buy here. It can't go any lower. And then next thing you know, oh, well, now it's down to 250. Well, it can't go any lower than 250. I'm going to buy some more here at 250. And then next thing you know, it's going up a little, but then it's down. And so I'm waiting for stocks to turn. I would have to see this thing trade above here's the 200-day moving average line. I'd have to see it. This is definitely a false breakout here, but I have to see it. I'd have to see the whole bottom turn. I'd have to see it above all the moving averages, and doing that for a couple weeks at a time before I would even consider getting long. It's the same thing with the SPY. I mean, if you're trying to pick tops, you're thinking, okay, well, if anyone knows about, you got a shoulder, a head, and a shoulder here, or you got a triple top here, you can even draw it. You can say, all right, well, here's a triple top. Here's the resistance. Trying to get this thing straight. There's no way that the SPY is going to keep going up. 1, 2, 3, 4, 5 times it's trying to get through resistance, and it can't. And then all of a sudden, it's going through resistance. Well, here's another double top. I'm going to short it up here. Well, there you go. So learning how to read charts is pretty you have to do it. You have to learn how to read, or at least rudimentary know how to look at charts before plunking your money down in the market, especially options trades. So, but that's also the reason why I like to sell puts against the grain of the market. If the market's going up, selling put options is one of the greatest strategies, because as the market goes up, put option values go down, and they'll just keep grinding out money month after month after month, as long as the stock continues to go up or even stays flat. You don't need the stock to go up. Stock could even go down, and you'll still make money as long as you're selling, these out of the money strikes here. If we look at, and these are some of the things that I like to do. I would like to see more of a pullback before I really go any harder on selling puts. But, if I'm looking at the SPY here, these are SPY options, and I go out to December.
It looks like we're not seeing your screen.
Oh, okay. Let me make sure I've got this thing shared. Give me a second. Screen share. Sorry about that. All right. We're looking at SPY options here. And SPY's at 664 and change. We're out in December, 80 days expiration. I mean, you're looking at a a 5% delta, which means there's only 5% chance that the SPY is going to come down, 120 points, and I'm still going to get compensated $200 for selling this thing. And I'd be okay buying the SPY $100 cheaper. I mean, at least at this moment in time, I'm thinking, okay, $545. I'll take $200 for that. My margin, the margin requirement, you have to put up money to sell puts. There's no other way around it. And if you have a cash account, you got to put up the full $54,000. That I don't like those kinds of trades. I like to do these things on margin. If I was going to sell this thing, I can see what the margin would be. It's probably going to be, hang on, let me put a price in here. Sell this thing for 205. My broker's only going to hold aside roughly $5,600 to make 200 on that. So let me just see what that return would be. 200 divided by 5,600. So that's about 3.5% return in 80 days, and annualized, whatever that would be. Let me see. That would be about, I don't know, 15, 16% annualized. Not so bad. Not so bad. But if you're using a cash account, it's a lot different. I don't like to put up that kind of money. So, if the SPY would, if we have a little pullback every now and again, that would be nice. Then I sell more puts because we know that the market's just not going to go down that far on a normal day-to-day basis. There's no reason to. Of course, we can't predict what kind of outside turmoil is going to happen. But if you worried about that all the time, then you're never going to invest in the market. We know the stock market has been the best wealth generator than any other asset. The stock market has been. So if you're always worried about, well, what if, and what happens if, well, then you're going to be too scared. You're never going to invest in the market. You have to be able to understand, and there's risks in investing, but if you're in it for the long haul, you can definitely make money. So that's the way I see it. So there's my little philosophy. I hope I didn't bore anybody with all that information.
No, that was good. And then real quick, can we revisit real quick the selling deep in the money puts? I'm still trying to wrap my head around that.
Sure.
It sounds super interesting. But is it like, did you say you sell 90 delta?
I'll pull up the option chain again here, and we'll look at Tesla, right? That's what we're looking at. Let me pull that up. Yeah, 90 delta puts you can sell. And in this case, that was the 680. Yeah, the 680 strike.
Yeah, so I never heard anybody else talk about this really. So to just sell the put by itself, you just have to have the money in your account to cover if you had to buy it at that price, unless you spread it off. Is it just like doing the opposite trade, I think, which more people do? It's just kind of in reverse here?
Well, if you have a margin account, so let me just see how much, if you were using a cash account, your broker would say you have to put up $68,000 in order to sell this put. Because if you were assigned, it would cost $68,000 to buy those 100 shares. Now, if you're just going to sell the put, let me put in a price of 240. Okay. And then if I hit transmit, so in this case, I'd have to put up $48,000. I mean, that's on margin. So that's actually a large chunk of change. The higher in the strikes you go, even in a margin account, you're going to have to put up a decent amount of money. If you're using cash account, it would be 68,000. Margin account would be 48,000. So there's still a decent amount of money you'd have to put up. It's a $20,000 difference. So you're using $20,000 less of your free cash, but you're getting $24,000 up front. Okay, you sell this thing for $240 a contract. That's at $24,000. That's going to get plunked right into your trading account. So you have $48,000 that's on hold with margin, but you're getting $24,000 extra dollars put into it. All that money's still sitting in your account. It's just off limits. And if your broker pays interest on free cash, you're going to get some interest money, 4% of whatever they're paying. So you make a little money that way as well. And as long as the stock goes up like you think it will, then this price will start to go down. And then you can, see how far it'll go down, how far the stock goes up, put option prices go down. And it's no different than buying the stock basically. If you bought 100 shares of stock, you just want the stock to go up. If you sell a deep in the money put, you still want the stock to go up.
Oh, I see. Yeah.
It's just a different way of playing a bullish position. But if you bought 100 shares of stock, it would cost you $44,200. In this case, as I said, your break even is, or your cost basis, break even cost basis is $440. If you were assigned the shares, you'd have to buy them at 680, I'm sorry, but you got $240 per contract up front. So that's how you figure out what your cost basis is. So basically anything above, as long as Tesla stays above $440 per share, you're making money. I understand it's a weird kind of concept. It's a different kind of concept that most people never thought about. But I think most people get concerned about the early assignment. They don't want to come up with the $48,000 of cash or the $68,000 of cash if they get assigned early. But if you get assigned early, that's not necessarily a bad thing, because then now you can start selling covered calls. And the call option prices on Tesla are so juicy that it actually would be a good thing if you got assigned early, as long as you have the money to pay for it. If you don't have the money to cover it, the broker's platform is not going to let you initiate the trade. They're not just going to let anybody sell a deep in the money 680 strike put on Tesla unless you have some cash in your account. So, right. There are some constraints there.
Right. So we have some questions from everything you've talked about, but I also want you to talk about that trick trade that I am so enamored with.
Right, right.
You think we should talk about that first and then hit the questions, or do you want to?
Sure, we can do that. Does the group know about these? Have you talked about these things with them?
No, not this one. This is new to me, even. I mean,
so I put out a YouTube video, I don't know, a few months ago, because people are always asking me what I do, my personal trades, and I kind of stumbled across a true can't lose trade. Now, I also made another video on that using collars, and Dan, you said you've talked about can't lose collar trades. But this one truly is a can't lose trades where I'm selling put options at a low strike price for more money than it costs me to buy higher strike put options. And it's only on put options. So imagine the stock's at 100. I can sell a 50 strike put for, let's say, 10 cents, but I can buy a 75 strike put for 5 cents. So as everybody knows, or you should know here, I'll share my screen one more time. In the world of put options, let's wait for these numbers to populate here. In the world of put options, the higher strike puts always cost more than its partner below it. So the 410 puts cost more than the 405 puts, and the 405 puts cost more than the 400 puts. That's how put options work. But I've somehow found a way to sell these 400 puts for more than what it costs me to buy the 405 puts. And it really only works on pretty volatile stocks that are very popular, I should say. And I did take a few screenshots I wanted to show everybody how these things work. Let me stop this share for a second and see if I have these things. All right, give me a second. I got to get these things behind the scenes here.
Sure.
Okay. So let me go back here. Share screen. This should work. Give me a second here. All right. Okay, Dan, can you see this
Yeah.
screen? Okay. So this is a screen capture of my some of my trading activity in one of my accounts on September 25th, 2025, which was last Thursday. Now I've blurred out the symbol here because I'm mostly still to this day kind of keeping this strategy a secret, since it's something that is kind of unique and I'm not really ready to divulge so much how it works. But um, the stock is the same, but I want to show you here what I've been doing. And it at the moment, it only works for one contract at a time. I can't sell five, I can't sell 10, I can't do 10, um, because whatever reason it doesn't work. So if you'll see here, this is the last trade of the day on September 25th at 1:17 p.m. and 29 seconds and 1:17 and 43 seconds. So what I do is I buy typically a higher strike put than the lower one, but in this case, I've been doing the same. In this one, it's the same strike. So within 14 seconds of each other, I was able to buy the 16 put for a penny and sell it for 6 cents. So I understand it's only $5, but if I'm doing these things a lot throughout the day, it adds up. $50 to $100 a day on multiple different stocks. Um, it's another way to make money without any risk. Now, the reason why there is no risk in this trade, well, first of all, these are all closed out. So I buy it at 1, sell it at 6. Buy it at 1, sell it at 6. Buy it at 1, sell it at 6. Let me bring up the other day's trading for me, and I'll show you another day. Let me pull that up.
Now, how long were those, like on average, between buying and selling? Like,
Some of them are seconds. Some are not more than a minute. Now I'll show you this one. Now again, I've grayed out the symbol, and here's September 26th, which was last Friday. This one lasted for a couple minutes at 3:46 p.m. and at 3:50 p.m. But here's what I did: I bought the 87 and a half put for a penny, but I was able to sell the 77 and a half put for 7 cents. So you can see I was able to purchase the higher strike put for cheaper than what I was able to sell the lower strike put for. That's a $10 wide. Now, in this case, the most I'm probably going to make is the $6. But if this stock managed to fall below $77.50, I'll make $1,000 on this spread right here, because I'll be able to sell it at $87.50, and then I'll buy it for $77.50. So my goal is for these stocks to crap out. And this stock was probably trading at $150 at the time. So I'm using very popular stocks, deep out of the money strikes. And you can see the prices are, a couple pennies each. Now, in this case, I was able to buy the 87 and a half put for a penny, and I sold the 75 strike put for 5 cents. Now, again, very small money trades, but continuously over the day on multiple stocks, it can add up. Some days I'm very busy, some days I have some more time on my hands. So I'm able to do these things. In this case, the 87 and a half put, I was able to buy at 1, and then I can sell it for 10 cents. Let me see what else. Here's another one. This was took about 5 minutes. I sold the 420 strike for 5, and I bought the 450 for a penny. That's a $30 wide spread right there. If this stock happened to fall below 420, I'd make $3,000 on this thing.
mm-hmm.
I think at the time the stock was probably trading over $600. So let me show you today's trade, and I have the symbol out on a couple, so I'll let you in on a couple of these. Let me bring the other one up on the screen. Stay with me. Okay. All right. This one's a little different. You can see the symbol Costco. This one I did on a spread. This one took about, it was about 8 minutes in between, but I was able to sell the 815, 810 put spread for a 20-cent credit. And I was able to buy the 825, 830 put spread higher strikes for a 2-cent debit. So it's an $18, 18 cents or $18 gain there. But once again, selling the lower strike, in this case, a spread, and buying a higher spread for cheaper money. This is just something that I can't really explain it. It's kind of something that I just stumbled upon. I'm able to make these kinds of trades. Now, here's one, and I'll show you the symbols Palantir. Many of you, I'm sure, know Palantir. Extremely popular stock right now. This trade took 10 seconds. You can see the timestamps right here. This was today. I sold the 70 put for 5 cents and I bought the 90 put for a penny. $20 in between.
Wow.
You're never going to be able to sell a lower strike put for more money than what it costs to buy a higher strike, but it's happening. I'm doing it. It's just, there's something there. I can't really explain it. I don't have bots that do this. I don't even think you can program bots to do this because it takes more finesse a little bit. You have to look for these things. You have to find these things. So, and you can see during the day, here's another one. The 155 puts I bought for a penny and I sold the 125 puts for 5 cents. Again, small amounts of money, but it can add up, especially if it's a guaranteed no lose kind of trade. Sure, I've got some commissions to pay, but they don't offset what I'm making on these trades. So it's just something that I've found in the market. Dan and I were talking about that the other day. This is why I love trading options, because there are anomalies in the market. And if you can find them and exploit them, then you can make yourself some money. I'm not breaking the bank here. It's just, little bits and pieces. But as long as I know that there's no risk, all right, so I'll put in the effort and make $5 or $6, multiple times. Why not?
Yeah. So that's really cool. Now I noticed that in the examples you showed us, they're out like around October 17, like 2 weeks.
Yeah.
Have you found that that's kind of a sweet spot, or?
That's a good question. I think the closer to expiration, probably within a month. Typically, I've been finding these things. I think the farther out you go, the opportunities are not there. Mostly because the closer to expiration ones have a lot more volume, which really doesn't matter to me. But a lot of people are playing those, so a lot of people are. And there's a lot of people that don't know how to really value options properly. So I think that's another reason why these things are happening. So, there's an idea for you. I didn't want to give it all away, but, if you want to take a look and try to find some of these stocks, go at it. Maybe you'll find some of your own. Let me know if you do. And then we'll be doing the same thing.
Yeah, thanks for sharing that. I'm going to be very busy looking through option chains. So you just manually go through them, right? You just
yeah, it's all manual. It's all trial and error. Like I said, I don't have a program. I don't have a bot. I don't have something working for me in the background. I'm manually sitting there looking at these option chains and saying, oh, okay, I think I found an anomaly. Let me try. Let me see if I can do it. And if it works, then I'll do another one and another one until it doesn't work.
Yeah. And when you find, go ahead.
And a lot of times during the day, I'll work it and then it'll stop working. Like I won't be able to do it. And then I'll come back an hour later and I'll try again and it'll work. So I can't tell you why it works, but it does.
Yeah.
And it doesn't work for every stock. It works for specific stocks. So you have to, if you're going to try to do this thing, you got to be prepared to spend some time, manual labor, going through your option chains, going through the expiration months, trying to find these stocks. and see if it works. It may not be worth your time, you know?
Yeah. But in the option chain, are you actually seeing those prices flickering around
Hmm.
at those different values that give you this? They give you the idea. Okay, this one could.
It's, the bid and asks are there. It's just whether you know how to work the bid and ask. I should say that if you kind of have some finesse with the bid ask prices, you could probably figure it out. But I don't want to give too much of it away.
Right. I understand. Yeah, thanks for sharing that. That's really cool.
Hmm.
So let me go back and see if hit some of these questions, if that's cool with you.
Sure, sure.
Can
I
you
can
see
look in
them?
the chat too.
Oh,
Uh,
good. Can you see them right
uh,
now?
yeah, I'm looking through the chat right now. I see. I can go back to 8:21 time wise. There's some questions that probably start around there. Okay, so I'll just kind of go through these. Some of the
Okay.
ones that are here. Jeff asked, "Do you have a preference of buying deep in the money call versus selling the out of the money put spread?" So as we said, I would rather sell the out of the money put spread, only because the risk reward is pretty much the same, and I'd rather get money than give out money, even though I know the end game could be the same result. For me, I just like selling options versus buying, even though it wouldn't have the same result. Let's see.
Is there any advantage one over the other, like with volatility or anything, or is it
No, because you're working with the same strikes, whether they're calls or puts. There's really going to be no difference. I mean, maybe a penny or two difference. If you buy the call spread, maybe you'll save a penny versus selling the put spread, or vice versa. It's really not. If you have a $5 wide spread, let's just say, and the call spread costs $4 to buy it, you're only going to be able to sell the put spread for $1. So it really doesn't matter which one you do, as
Mhm.
long as the numbers are pretty much matching up. Now, if you can buy the call spread for, let's say, 375, and your return would be 125, and you can only do the put spread for $1, then in that case, it's worth buying the call spread. So you have to look at the numbers on each side, but through the put call parity, the call spread and the put spread should be trading pretty much the same risk reward. So it really doesn't matter. But like I
Right.
said, I'd rather sell the options than buy them, because my money stays intact in my account. Versus
Yeah.
when you buy something, you have to give out your money.
Right.
Um, so I'm looking through the questions here. Nelson says, "How do you hedge against the black swan with your strategy?" Well, as we talked about earlier, black swans are bad. If you're on the wrong side of them. I typically don't have unlimited risk. Like, I mean, if I sell put options, we know what the ultimate risk is that the stock can go to zero. I do sell those SPX options on a, I do sell those SPX options, but so far, I really haven't had issues with them. I mean, I know how to get out of these trades, but if I'm selling naked puts on individual stocks, I need to make sure that if I get assigned, I'm okay with it, which most of the stocks that I sell put options are, I'm okay with it. So, um, hedging against a black swan, I really don't too much. I know what I'm getting into. And if I'm underwater for a period of time, well, then I'll try to sell some covered calls if I can to make up some of the difference. But then I just end up holding. You buy and you hold. And if it's a stock that eventually I realize, this is a dud, which could happen, then I got to take my lumps and get out, take the loss. Jeff also asked, "How long would you hold that deep in the money put on Tesla?" Well, that depends. I mean, how much money are you willing to are looking to make? If you sell that thing for what we say, $240 a contract, I think that's what it was. If it decays down to 220 or 200, where do you get out? In our newsletter, we always get out of a trade when we've captured 80% of the value of the put option. So if we sold a put option for $1 a contract, if it decays down to 20 cents a contract, that's an 80% decline. We would buy that put option back for 20 cents a contract. So in our newsletter, we use the 80% rule. So anything that we've sold, once it decays 80%, we're buying it back to lock it in. We don't usually let put options go to expiration. We'll take the money, we'll take our 80% and go and put our money towards a different trade, our new trade. Backwardation plays a part on the onesies strategy. Not so much sure what you mean on that. There's no rhyme or reason for these things. These are pretty popular stocks, so people do buy downside puts for protection purposes. That could play a part in it, but backwardation, I'm not really so sure that has anything to do with it. And then Jeff asks again, for selling puts, how many days expiration do you like to sell? In our newsletter, which I'll give you information for, we're typically anywhere from 30 to 60 days out. Sometimes we'll go to a 90-day expiration, but we typically won't hold it for that long. Most of our trades are closed out within 45 to 60 days is probably our ballpark area. Me personally, when I sell puts for myself, I'll do 0 days expiration, 1 day to expiration, 1 week, 1 month, just depends what I'm seeing. But in our newsletter, it's typically a 30 to 60 day expiration. And we'll always play in between earnings announcements. Okay, we don't like to hold a position over an earnings announcements because, as we know, anything could happen after an earnings. So when we put on a trade, we make sure that the option is going to expire before the next earnings announcement. That way we don't have to hold and pray that stock doesn't go against us. Last question that I see in here. Do you think people using market orders helps you get filled on those puts you are buying for a penny? Not typically, because there's already a penny. Usually when I make these trades, there's already someone else's penny bid in there. So I'm able to buy it for a penny. While a lot of other people are trying to buy them for a penny as well. So I don't think that's part of the reason why. I know I'm being a little vague on this, only because as I said, I'm not ready to give it all away. It's just something that the way the bid ask work on these options that are allowing me to make these trades. So that's really as much as I'm going to say on that. But I hope that all the other information that I've talked to, at least you'll come away with some information and ideas and content here. I don't want to. I don't want anyone to walk away and say, geez, this guy didn't give me any information that I could use. I hope some of this has been helpful, just to give you an idea of, what I've been doing, the kinds of trades that I make.
Yeah, absolutely. And I appreciate you sharing that. And it gets the wheels turning, which is the big thing for me. You want to talk more? You want to talk a little bit about what you do on your site there? You have a couple.
Sure.
A great free report, and the Warren Buffett thing I think is interesting, and then your newsletter as well.
Sure. Let me just pull up the share a screen here. So if anyone is interested in put selling and learning more about put selling, if you're a little new to the game, you go to our website, smartoptionseller.com. Here's up here. Under the More tab here, free ebook, Put Selling Basics. It's like a, 35, 40 page ebook that I wrote on how to sell put options the way that we do it. It's free. You can, scroll down here, put your name and email address, and you'll get an email from us with a link for the free copy. Or anywhere on our site you see this box, you can put your name and email address in here, and you'll get the free copy here. What I'll do is I'll put the link in the chat box. Let me do that for everybody.
Yeah.
Chat box here.
I'll put it in the description as well later on.
Okay, so I just put it in the chat box. Let me go back to the website here. Um, so I wrote this Warren Buffett ebook also on our site. It's pretty much using the deep in the money call, not spreads, but deep in the money individual call option buying strategy. And we use it as a way to piggyback off of Warren Buffett. I tell a lot of people, if you're not sure which stocks to buy or which stocks to choose, just follow Buffett. I mean, he runs a fund slash ETF himself. His Berkshire Hathaway fund is made up of dozens of stocks that over the course of his 60 years running that thing has just made tons and tons of money. Might as well just piggyback off of him, ride his coattails, and use a deep in the money call, buy deep in the money call instead of buying the shares of his stock or his fund. So I wrote this ebook, and if you want to see how it's done, click here, click on here. I'll put the link in here as well in the chat. We don't have a service that buys deep in the money calls. This is just something that I do outside of our newsletters. So our two newsletters, and I'll go back to the screen one more time. Sorry to keep jumping around like this. Under our services tab here, we have two newsletters. One of them is selling naked puts. The other is selling put option credit spreads. And we have our coaching, and we also have our probability calculator, which we like to use because it allows you to see what your chances are of a stock going from point A to point B in the amount of time of your option expiration. And it gives you an idea of whether you have good chances or bad chances to win or lose on a trade. So we have a lot of people that like to use the calculator. So that's pretty much it on my end. We are running, I will make this plug, we are running a put selling webinar. This is something that I do twice a year. Take a deep dive into put selling. We go 2 sessions, and overall it's about 5 hours of Zoom like this. Show you lots of slides, teach you how to sell put options, and then you get 30 days free to our newsletter, in addition to access to the calculator and all my other cheat sheets and spreadsheets and all that. So I'll also put this in the share, and that'll be the end of my plugs.
And I'll include all those too, both in the YouTube video, and also we have an area for these in my school site. I'll put those in there. But I saw that you had 2 services. What are the differences between those 2 services?
The one newsletter is just selling naked puts, and we use strike prices $50 and under in that service, because if we're assigned on a $50 strike put, you're going to buy 100 shares at $50. That's $5,000 investment. Running this thing for a number of years, most of the members in that service could afford a $5,000 investment. The other newsletter is selling put option credit spreads, typically $5 wide. And we can use those on any type of stock: Tesla, Costco, NVDA, all these expensive stocks. We use $5 wide spreads. And so your risk is never more than $500. And selling puts and selling put option credit spreads are both bullishly oriented strategies. I'm a bull, always a bull. So we look for stocks that are in uptrends or pulling back within the uptrend and getting ready to go up again. That's pretty much how I find the plays. I pick the stock, I pick the strike prices, I send everything to you via email. We have text alerts as well. So I do all the hard work, and you can see all that information with those links that I've attached.
Yeah. And also be sure to check out Lee's YouTube channel. That thing is amazing. It's got a ton of great content. So be sure to subscribe to that. All right. Thanks again, Lee, for doing this for us. Really appreciate it. It's super cool of you to come on here and share all this goodness with us. Very much appreciated. And I'll include links to all the links that you you posted in the chat here, I'll go ahead and I'll repost them in the video description below. So if you want to check those out, just look in the description below. And I also think I'll put together like a special page on my website with all these same links, and also some links to some of my favorite YouTube videos that Lee's made that you can find on his channel. I highly recommend you going over to his YouTube channel and checking that out. He's got a ton of great stuff on there. So I'll include a link to his YouTube channel as well. Go over there, subscribe, and check that out. All right, that's it for this one. Thanks again, Lee Lowell, for coming on here and sharing all this great info with us. Very much appreciated. Great ideas, super insightful. Again, everyone go over and check out his YouTube channel and his website. You'll find the links to those in the description below. Go check out what he's got going on. All right, that's it for this one. We'll see you in the next one.